Hi, Tony.
Hello, how are
Morning,
you?
Tony.
Hello.
The future's so bright, Tony.
Yeah, I've just been, I had to go to the optometrist and they've dilated my pupils, so I've got to keep my sunglasses
Oh
on
boy. Yeah, I've been there.
for a half a day. Yeah.
They've dilated your pupils.
They do that so they can photograph the retina.
Right.
Hmm.
Oh, okay.
It's all ahead of you, Cam.
Oh, dude, the medical problems I already have are enough. I don't need more. You're not that much older than me.
True, but it seems to all be happening at once.
I've stopped counting the amount of pills I have to take in the morning. It's getting ridiculous.
Oh, really? Okay.
Yeah.
I only have to take one, but I do take some other vitamins and that
Yeah,
kind of
well, some of them are, hay fever and I don't know,
stuff.
not big things.
Yeah.
Anywho,
Hey, glad to hear you there. It was a pretty windy day and rainy day in Brisbane yesterday.
well, we lost power. We lost power for about 6 hours last night.
Oh boy.
So I was thinking, we lost power, the internet was down, and obviously, but we were also getting messages from the broadband provider saying it was down because I think power lines and cables had come down. Big storm we had here, David. And but yes, it came back on about midnight. So it was a
And you
warm.
guys are in summer, late summer, right?
Yeah, and where I live in Brisbane, it's very tropical climate. So we had a big tropical storm, and then power's cut out. It's muggy, hot, no air conditioner, no fans.
Well, the
no
wind must be
breeze coming
global
through
because
the
we
window.
had big winds here yesterday as well.
Oh, there you go.
Yeah.
Where are you based, David?
I'm in South Central Pennsylvania, outside of the state capital of Harrisburg.
Oh, wow. Okay.
About 3 hours from New York City.
And where is that in
A couple
relation
hours from Philadelphia. I'm sorry?
Pittsburgh, that down that way? Whereabouts?
Yeah,
is
Pittsburgh's about 3 hours west.
Right, okay.
Philadelphia is about 2 hours east.
So you're right in the
Manhattan.
middle. I've been to Pittsburgh. That's a nice city.
Oh, it's a great city.
Yeah. Yeah.
Ride the vernaculars up and down the mountains.
I did, yes.
Yeah, a lot of fun, right?
Great museums there as well.
Yes, absolutely.
And have you been having a snow apocalypse there like they're getting in Texas?
Probably, we've probably had more snow here than we normally have this winter. We're in a valley where it's, kind of a 1 inch or less kind of area. But we've had some pretty big storms this winter.
Yeah.
You just never know anymore what you're going to get hit with.
Yes.
Unpredictable, just like investing, right?
Well, investing is pretty predictable, isn't it?
Well, I should say, just like stock trading, it's unpredictable.
Yeah.
Yeah. In the short term, it's unpredictable. In the long term, it's predictable.
Exactly. There you go. Perfect.
Yeah. Well, let's get into it. Obviously, for people tuning in, we're talking today. Welcome back to QAV, by the way. Episode, I think this is 409. Our guest today coming to us, as you've just heard, from Pennsylvania, David Waldron, author of Build Wealth with Common Stocks. Welcome to the show, David.
Thank you, Cameron and Tony. It's great to be here. Thanks for having me.
Why don't you start by telling us a little bit about your investing journey? When did you start and how did it develop?
I started, I would guess, about 23 years ago, 1998, working in my field. My former career, which I retired from, was in post-secondary career education. I ran campuses as a campus president. And of course, we had, the States, we call them the 401k, but the retirement plan, was kind of thrown at us, and it's up to you to work the mutual funds and eventually the ETFs to figure out, how to make something of it. And that's where I started getting involved in investing. And, at that time, mostly mutual funds. And I had a lot of hits and misses. I eventually started investing in stocks maybe after the dot-com crash of 2000, and did all the wrong things: macro investing, top-down investing, putting together my own indexes of biotechnology funds, and this trend and that trend. Probably, paid my my tuition in stock losses, as I call it. But eventually, I started reading the quarterly reports that you get from mutual funds, or when they were popular back then, from investors in the States, such as Marty Whitman and Charles Royce from the Royce funds. William Brown from Tweedy Brown Global Value, pretty popular fund. And these guys were talking about in their quarterly reports, very entertaining presentation on value investing, which kind of struck me for the first time. They talked about Warren Buffett, Charlie Munger, and Ben Graham. And it just caught my attention. So it was one of those things that I just naturally absorbed the information. Whereas I think a lot of the other investing information was kind of like, whether it made sense to me or not, I just tried it. So even though I was paying too much for the mutual funds in the form of fees, I learned a lot from the quarterly reports, and I eventually started applying it. And I guess around, reading books, I read all the books, Graham and Buffett and Peter Lynch and all those guys. And eventually about 12 years ago, it started clicking for me. I got out of buying and selling stocks on news and that kind of crazy stuff, and started applying value investing 100%. And before I knew it, I was beating the market. Not that I was trying to, but as I measure, it's like, wow, this is actually working. Nothing I invented, everything was learned. And then I started writing about it in some publications like Seeking Alpha and Talk Markets, kind of sharing my experiences, with the public. I just felt that was an obligation. And then that led to the book, which just came out last month. So really, it's just my experience in value investing, and that it really does work. If you buy into it, you believe in it, and you stick with it, it's definitely a very powerful investment paradigm.
But David,
I'm preaching to the choir here, so
value investing is meant to be dead, isn't it?
Oh, of course, but it's never dead. It's just overtaken by short-term growth stories, right?
Yeah, exactly.
Or muted by short-term growth stories.
Your story sounds exactly like my story. Similar sort of thing, similar sort of period as well. Similar sort of coming to Jesus moment with Warren Buffett and his writings and Charlie Munger's writings. But yeah, very similar. So why, I guess the question is, what attracts people like us to value investing over growth investing? If there's money to be made in growth, why wouldn't you buy growth stocks?
Well, I guess from my experience, you have to fail at growth investing and then succeed at value investing to come to that conclusion. But I think a lot of people are either succeeding at growth investing or think they are. And, I've heard you say, Tony, and it's said many times before, is that, all investing is value investing. Ultimately, everybody's trying to buy something that's going to go up in price. That's value and price. But I think to me, the tenets of value is not just value. It's also about discipline. It's also about patience. It's also about long-term versus short-term. To me, there's a lot of ancillary things that go with value investing that makes it so powerful.
Yeah, I agree. For me, it's growth investing tends to be about the story, because you just can't make a decision based on the numbers, whereas value investing is more scientific. It's based on the numbers. And I think you make a good point that people get drawn to growth investing until it stops. It's like I remember a property developer telling me that the last development property developers do is the one that fails, and then they get out of the business. And same with growth investing, right?
That's right.
Yeah.
Yeah, they always say when condos are being built left and right, it's the end of the real estate.
Yeah, that's right. Yeah, don't buy a condo. Yeah, exactly. Do you, speaking of the sort of scientific approach, do you use a checklist at all when you're deciding to buy a stock?
Yes, I do I have a checklist, not as extensive as yours, Tony. Yours is a very impressive one, I might add. I basically follow 5 strategies. Define the value, which of course have a lot of checklists within each strategy, but the 5 are define the value proposition of the company, quantify the shareholder yields, measure the returns on management, weigh the valuation multiples, and then also assess the downside risk. And once I've done all 5 and all the checklists within that, then I determine whether, in my view, the stock of that company is a bull situation right now, a neutral situation, or a bear situation, and then make investment decisions based on that.
And what kind of metrics do you use to do that? Like particularly on how do you value management? Are you using return on investment, for example, or something else?
Yeah, management will look at return on equity, return on invested capital are 2 of my favorites. Return on equity, of course, and I've heard you and Cameron talk about this on your podcast. Is there's caveats with all these formulas. Return on equity, you got to be careful with stock buybacks inflating return on equity and things like that. But I think overall, return on equity does give you a good picture if you're looking at over long term of what management's doing. Return on invested capital is probably number one from Benjamin Graham, and I agree with that. Also look at I like to read the 10Ks, the annual reports of the companies. I like to listen in on conference calls. I think a lot of when I listen to a conference call, I'm thinking to myself, I'm thinking of the analysts and a lot of investors listening to the content. They want to hear the numbers and where they're going to go next year with the company. And what I'm doing is I'm listening to the context. Do they sound like they really believe what they're talking about? I'm listening for the EQ, the executive, or the emotional quotient of the executives to see if they really sound like they believe in what they're promoting and predicting and forecasting.
So do you somehow factor that into a checklist? Do you score management based on their EQ, for example?
Yeah, that's a good question. It's probably something that's hard to put in a checklist, but it's something I certainly have on the checklist. Jump onto a conference call, listen to not what they're saying, but how they're saying it and why they're saying it. But I would say, going back to your original question, return on equity, return on invested capital are my two big return on management numbers. I also look at growth, previous growth in revenue and earnings.
Mm-hmm.
I stay more into factual numbers as opposed to predictable kind of things.
Mm-hmm.
I'm trying to predict things, I should say.
Yeah, it's hard, isn't it? Getting back to the management side of things, I just find that fascinating that you're factoring in that kind of soft side, I'll call it, your context, as you call it. Who would you say in your investing universe would be the best manager or a good manager that we could look at as a prototype?
Well, the ones that score high on my quote unquote checklist would be Tim Cook at Apple.
Okay.
For example, I think here's a situation where a lot of investors, this investor included, sold Apple after Steve Jobs passed away. So I figure, how can a company get better than Steve Jobs? Mm. Then realizing that Tim Cook was handpicked by Steve Jobs. I could have done better research there. And Steve Jobs actually groomed Tim Cook to eventually be a successor, probably not as soon as he wanted it to be, but and Tim Cook is just it's incredible what he's done. He's done more for that company than Steve Jobs did as far as outcomes. So when I look at Tim Cook, I think of a very powerful manager. I think a lot of people say that about Jeff Bezos of Amazon. Just strong managers, but at the same time, I also agree with Warren Buffett. CEOs come and go. Don't buy and sell stocks based on the CEO because they're going to come and go. Look for companies that have an enduring quality of management, and those are the companies that you want to invest in and stick with.
Yeah. So he's spoken a lot about that, hasn't he? About the company has to be good enough to be run by an idiot because one day it will be, is his famous saying about that. Yeah,
absolutely. That's a great one. One of my favorites.
Yeah. Although, I mean, there's certainly evidence for and against that. I remember reading Good to Great by Jim Collins 30 years ago.
And one of my favorite books.
And then I think it was about 20 years ago, someone came along and looked at those companies that were in Good to Great, and I think all but one had been bankrupted in the intervening period. So, sometimes things don't last forever.
It works both ways.
Yeah, it does. Yeah. Okay, so you've been investing for a long time. Tell us about what kind of returns are you getting in the market?
Well, I have, actually, what I disclose publicly is more of the average return per holding versus the S&P 500 or the the American index. But I do have to get that question from you, Tony. So I'm prepared for it. So I did my crunching today. So at the close of yesterday's market, I first started investing in common stocks based on what I talk about in the book, The Model Portfolio, in June of 2009. So what I did is I took all 17 holdings, the day of the purchase, what I pay for, adjusted for splits and dividends, cost basis. Also looked at on the same day, if I spent using $1,000 benchmark. So let's say we put $1,000 into the stock on that day, and also put $1,000 into the index on the same day. And I did that for all 17 stocks based on all the 17 different entry points. And the portfolio has returned an annualized average of 17.21% versus 9.2% for the market.
Yeah,
So
fantastic.
almost twice, not as high as you're close to 20%. And I think your very detailed checklist, I think, gets you that extra 2 points. So congratulations, but I'm very happy with my results as well.
Absolutely. Yeah. I think once you're getting sort of up around double market, yeah, some years you'll be above that, some years you'll be below it. But I think, relatively it's a good space to be in. That's great. So well done. So
Thank you very much.
you've got a portfolio. Are you saying, or are you suggesting that you've held those 17 stocks since that 2009 time, or have you traded
Yes.
them away?
Yeah, I've actually had the 17. I actually had 20. There was 3 that I did sell. So I did not include that here, but one of them I sold above. One was even, one was a little below. So I'm not sure it would have made a big difference. That was Becton Dickinson, IBM, and ExxonMobil are 3 stocks I sold during that time, but that's it. I haven't sold a stock in over 4 years.
No, that's great. What caused you to sell those stocks? Do you have a checklist for selling as well?
Not probably as big a one as I should have, but Becton Dickinson, probably one of my regrets on a sale. I think that's one of those where I was on a conference call and just was not impressed at all. And the numbers on my sheets were not looking good either. So I got out thinking I was ahead of the curve. But one thing that Becton Dickinson has going for it is predictable revenue. And here it is 4 years later, that predictable revenue is still working for them.
Yeah, right.
So the stock has actually done better since I've sold it, but that's okay. Lesson learned.
Yep.
ExxonMobil, I wrote an article about this and I said, I better practice what I preach. And my article was called Energy Stock Prices Go Up and Down with Energy Prices, Not the Quality of the Company.
Yes.
I've learned that a lot. If you want to own energy stocks, in my book, just buy an energy ETF and you get the same result, good or bad. And then the other stock was IBM. I just got tired of the flatlining, and on their quarter reports. Even though I tend not to buy or sell on quarter reports, it just got to the point where I didn't see any more hope for the company. Decided to get out.
Right.
That's it. That's the last one I sold. It had to be 4 years ago.
Yeah. Gee, it's interesting, isn't it? You're doing well through that strategy. I'm doing well through that strategy, and yet, I often feel like I'm the only person that's using that kind of strategy, and now there's you as well. Why do you think that more people aren't embracing a long-term approach to A, do it themselves, and B, take a more technical or value approach to investing?
My top of mind answer on that is Wall Street, as I call it. Wall Street to me is any professional investing anywhere in the world. I just call it Wall Street in the book. Is very good at propagandizing the investment paradigm towards fees as opposed to performance. Now, of course, nobody out there invests based, I want to pay fees, so let me invest. That's like somebody saying, I want to smoke a cigarette because I want to get cancer. But I think the propaganda between the talking heads and all the articles of which I was part of too, as a writer, or article writer on Seeking Alpha and Talk Markets, after a while, people start buying into the notion of, hey, it's the quarterly report that matters. It's the CEO that matters. It's the trends that matter, where the product is trending towards. And that's what people are buying and selling on. And when you get caught up in that trap, it becomes a short-term game by accident almost than on purpose, in my view.
Yeah, look, I tend to agree with you. I think Wall Street and Macquarie Street in Australia, or Collins Street in Melbourne, it often treats investors like prey. It's how can we squeeze some more funds under management from these people, rather than what's in the best interest of these people. And that's where the government struggle here, is to try and set up a series of codes and laws that can govern the wealth management industry, when they should be acting for the best interests of their clients, but they're really acting for the best interests of their companies. And that's the dilemma, isn't it?
That's right, Tony, because if you look at, if you believe the statistics that say less than a minority of professional investors actually consistently outperform their benchmark, obviously if they leverage their business based on that performance, they wouldn't last very long. So what they do have to do is they have to spin other things in order to create the fees. And I'm a skeptic when it comes to that, but that's how I see it.
Look, I agree with you, but it begs the question: if as individuals we're doing this, and I'll speak for myself, I kind of stumbled into it, and then saw it was a great way to set up an independent life. But why haven't the professionals been taught how to do this, and why aren't they doing this? Why are they always tending to at least perform the index, if not underperform the index? Why haven't they cottoned on to this style of investing? I don't get that.
Buy and hold.
Buy and hold, but also
Doesn't make
a
money.
more value approach rather than a growth approach or a story approach.
For some reason, they're convinced value is dead, as you said before.
Yeah.
Constantly. That's not a new story. That story has been going on for years.
Yeah.
It just comes out every once in a while. I think the Wall Street Journal ever pulls their value investing is dead article out and shakes it off, shakes the dust off. It does a little editing to update it and reprints it. It's just a belief system, I guess. But I guess it really goes down to taking responsibility. I think we just have to take responsibility and know that anything we buy in life, whether it's a car or a house or whatever, is we're always placing value on it. So why are we not doing that when we're investing?
Yeah, right. Yeah. So
why is it different when investing?
But it comes down to us, doesn't it, as end users, to apply that sort of discipline. And we're not taught to. I don't know about American schools or colleges, but we're not taught to do that with our finances. We're not taught to how to invest. We're not taught to watch out for certain things like short-term quarterly earnings or whatever, or the fees that are being paid. It's almost like the deck gets stacked against the individual from the start, and it's probably stacked there by people who profit from that, which is the people who should be teaching people how to invest properly and doing it themselves, by the way.
Yeah, a good historical example in my former career as an executive, one of my roles was to host financial analysts and hedge fund managers at my campus in Boston, Massachusetts, for them to kick the tires, as they would call it. So these analysts, and some of them are pretty well-known superstars now, not because they visited me, but for other reasons. And they focused on the now. What are you guys doing right now?
Yeah.
What are you going to deliver tomorrow? And what are you going to deliver next month? And I kind of followed some of them, and we had big annual events with sell-side analysts. We had breakfast for them, big prep. All my people had to do these presentations for them. And one thing I noticed back then, I'm not sure I was really aware of it then, but when I started looking back, when I really got into value investing, I realized the short-term mentality of what they're doing.
Yeah.
So what are you guys going to deliver next month and next quarter? Because next year doesn't matter to our clients. Our clients want to know what you're going to do now.
It's not what have you done, it's what have you done for me lately.
It's the machine.
And that's bringing an operational business mentality to an investing situation, which really should be looking at the long term, not the short term.
And by the way, these are great people. These are great group of people. I had no issues with them personally.
Yeah.
But the short-term thinking is how they're trained.
Yeah.
And they're just doing their jobs.
It's kind of ironic that kind of capitalism leads us to that situation, and we're investing in capitalism, but it's the worst way to invest in capitalism. So it's kind of ironic.
I never heard it put that way. That's brilliant. Yeah.
But I get it, and it's and I guess also too, Wall Street in inverted commas makes its money by churn. So they love the fact that markets will move from value to growth, because that means you've sold some of your portfolio or all of your portfolio, and that gives them a fee.
It's the fees.
Yeah. Anyway, look, enough of that sort of philosophizing about what's wrong. We're both doing well, so we should focus on that instead. You talk in your book about ETFs and how you hedge your portfolio. Could you expand on that, please?
Yes. At one time, I had ETFs as a passive, from a passive standpoint, mutual funds, I guess you could say too. And what I've kind of transitioned to when I really started getting confident about investing in common stocks is hedging is important. I'm not a short seller. I've never shorted a stock in my life. I never will. It's just not for me. I have a tongue twister, to be short sellers are left short until they lose their shirts. So for me, how can I hedge? If I'm not going to short a stock on the other side, how can I hedge? And to me, the best approach would be take an ETF, either of your benchmark. So my particular portfolio is benchmarked to the S&P 500. So I wanted to do a direct hedge. Obviously, an S&P 500 index like a VU from Vanguard would work. I kind of take more of a contrarian approach to that. So my primary, even though I have used the benchmark in the past, I've also used TIPS, tuition inflation protected securities, because the number one threat to stocks is inflation, of course. But right now, my primary hedge is the Vanguard FTSE All World ex-US, so all international stocks outside of the United States in my particular situation.
Mm-hmm.
And I find, even though a lot of times, Tony, as you know, sometimes international stocks and Australian stocks and international stocks, American stocks go up and down together, but sometimes they don't. And we got to be prepared to have some kind of hedge. And to me, that's the easiest, simplest way for a do-it-yourself investor to hedge is through ETFs.
So when you say hedge, what do you mean by that? Because typically in my mind, a hedge means I'm buying airlines and I'm buying oil, and they both, one goes up and one goes down. If the oil price rises, the airline stock goes down because their major cost is fuel, and vice versa. So is that what you're doing, or are you doing something?
Yeah, it's a hedge more from a broad, I guess maybe from a broader standpoint. That's definitely an excellent hedge within that industry. From a broader standpoint, if I have a basket of stocks all in the S&P 500 or all in the ACX, what can I hedge that against that's contrarian to that overall on a broad market standpoint? That if this market goes down for the next 3 months or 4 months or 5 months or 6 months and takes everybody with it, what might be on the other side that might be going up to kind of keep the portfolio stable? So I'm looking at it more from a broader standpoint.
Is that a 50-50 hedge, or how do you weight that?
No, the hedge would be more like 25-30%. Much less. I don't go 50-50, even though as I get older, I might consider that.
Okay, so don't you find that even though you're smoothing out the volatility, you might be reducing your overall returns because one's going up and the other one's going down? So the average is kind of flatlining?
That's possible. I mean, the VU has been an okay return. It's positive for me, but nothing fantastic. But again, that's the investment I make, saying this is the one that it's there if I need it. So that's if I'm diversified in any way, that's my diversification. I mean, I believe in a basket that should be concentrated of stocks. But if I'm going to do any diversification, it's going to be with the ETF hedges.
Okay. So you spoke before about inflation. Could you just and in your book you spoke about the hidden cost of inflation. Could you talk a bit about that and whether you're hedging against that or how you're taking into account in your portfolio construction, please?
Yeah, I have. I might take a look at it again. With the interest rates apparently rising, we'll see what happens with that. But I have hedged my portfolio with the TIPS, tuition inflation protected securities, which by design, whether it always works out the way or not is another question. But by design, are designed to go up when inflation rises. So that's a good hedge against stocks, which tend to have trouble with inflation. So I think TIPS, if this inflation, eventually with this whole bond thing that's been going on for the past 30 years, if bonds come back and everybody gets back into bond yields again, obviously TIPS are going to make sense to hedge stock portfolios in my book.
We don't have anything like it. Well, sorry, we probably do have something like TIPS in Australia, but could you just explain what that product is?
Well, the one I've invested in is the Vanguard TIPS. Tuition inflation protected securities is a basket of government securities that, and I tend to go on the short term as opposed to intermediate or long term TIPS. And again, I really can't get into the detail of it as far as an understanding, but I do know from studying the prospectuses and the quarterly reports and such from Vanguard that it's an excellent hedge against rising inflation and rising interest rates.
So it's basically a Vanguard package product, which is some kind of fund.
It's all government securities.
It's all government securities. Okay.
Yes.
And you're
in the fund. Yeah.
Again, in terms of hedging your portfolio, how much weight do you put into that kind of product?
Again, it wouldn't be more than 10 to 25%.
Okay.
Yeah, my portfolio is majority common stocks, common shares. However, I have other things outside of the portfolio that might be cash and things like that. But within the portfolio itself, and that's the way I look at it as a separate independent basket. There might be some ETFs in there at any given time just to hedge potential downturns.
And the hedging side of things, is that because you're now in a situation where you're living off the income from the portfolio? So you want to make sure you don't suffer periods of volatility?
Correct, but I'm an author. I am still working as an author,
Hmm.
so that's my income.
Sure.
So I still, for me personally, I still see, even though I may look like I'm past retirement, I'm still looking forward to having my portfolio grow. So when I do actually retire, it will be there for us.
Sorry, I didn't mean
No, I'm just
that way.
I'm self-deprecating, Tony. No worries.
That's okay. What you're describing is kind of what people would do if they were in full retirement mode and they were trying to make sure that they got a certain level of income every year, rather than being in growth mode, where over the long term you can suffer periods of volatility because you're going to get an increased income longer term.
Yeah, absolutely. What you make me think of too, what I'm trying to avoid with my approach, which is also your approach, Warren Buffett's approach, the best approach, I think, is avoid getting into that high dividend yield trap that a lot of retirees are in right now.
Yeah.
I talk about in the book,
where
they're chasing yield. And I don't know about you, I see it as a very dangerous escapade.
It is, and it's plenty of broken roads littered with high yield shares and even schemes in Australia, which haven't worked out well for people. And in fact, the big one after the GFC was the banking stocks in Australia, which started to pay out up to 90% of their income as dividends, and retirees flooded into them, and then they went through their downturn, because you can't run a business if you're investing 10% back into the company. And those people got caught there. And then just on a day or so ago, I was reading Warren Buffett's annual letter to the Berkshire Hathaway shareholders, and he called out people who were chasing yield into lower grade bonds and reminded people of how that didn't do well back in the 80s.
That's right.
Yeah. But it's an interesting world we find ourselves in, where if you are a retiree, you're left with very little option to gain some kind of income. Annuities are paying nothing. Bank deposits are paying nothing. You really have to take on the risk of owning a share and getting their sort of, or an index fund, and getting the average yield from the market as the best alternative.
Yeah, absolutely. As controversial as it is, I'm a believer in yield on cost. Mm-hmm. And I try to remind my readers that, don't not buy a great stock at a great price because it's yielding 1.1%. Because 10 years from now, if you do the yield based on what you paid for the stock 10 years ago, it might be yielding you 10, 12, 15%.
Exactly. Yeah, that's a really good point.
That's the kind of high yield stocks I like.
Yes, I agree. Well, we spoke about one just recently, an investment bank in Australia called Macquarie Bank, just recently wrote to its shareholders, offered them a high yield hybrid. So I don't know if they have those in the States, but it's a bond, a corporate bond, which can be converted back into shares at 10 years' time. Although all of the conversion metrics are stacked in favour of the bank, they decide when it happens and whether you get cash or shares and all that kind of stuff. But the high yielding note that they were marketing was about 0.75% higher than the yield on the stock. And the stock's a great investment. So you'd expect in 10 years' time to receive multiples of yield if you invested in the stock rather than in the bond.
Yes, yeah. And one of the things I learned from Warren Buffett is make sure when you're investing in stocks that you look at how the stock is yielding for the shareholder compared to the 10-year Treasury, or in Australia, the 10-year Australian bond. Mm-hmm. And that could really be a telling story of whether the stock is better than owning a bond right now, or whether the stock is worse than owning a bond right now.
And when you say yield, you're talking about the earnings yield there rather than the dividend yield, yeah?
Yeah, earnings yield. I also look at free cash flow yield.
Yeah, okay.
Those types of yields, and I compare it to the 10-year Treasury to see if the stock is significantly outperforming the Treasury. If not, then why not just own the Treasury, right?
Yeah, exactly. Yeah,
or less risk.
Buy the stock. That's a pretty low bar these days when Treasuries are yielding, less than 1%.
Oh God, it's nuts.
Yeah, if your company can't earn more than 1%, it should be probably bought by somebody else who can make it run better. Yeah.
Yeah, most of the times, most of those formulas are when the yields were more like 3%, 4%.
Yeah, no, exactly.
And you get a stock yielding 6, 8% on the cash flow side, not the dividend side.
Yes.
Then you say, okay, now we got something that's worth owning over a Treasury.
Yeah. Cam, I've monopolised conversation here. Do you have any questions for our interview guest?
Yes, I've got a few. I was just going to point out as a side note that I enjoyed seeing that the title of your first chapter is Get Rich Slow, which was also the title of our very first episode back in 2019. So as soon as I saw that, I thought, okay, we're on the same page as this guy. I noticed in the book, in your model portfolio, you included Microsoft, and earlier you talked about owning Apple. That surprised me, both of those, because they are stocks that I think would struggle to get through Tony's checklist. And it also saddened me to see how much Microsoft's share prices had grown since you added them to the model portfolio, because as our listeners know, I used to work there and I left there with a large sum of shares and I sold them in 2004. And if I just held on to them, who knows? But anyway, can you explain because I think you're in the book, you mentioned that your process for choosing Microsoft for the model portfolio was a little bit different than you used for some of the other stocks. Can you talk us through how that ended up in there?
Well, Microsoft, I think I bought it back in 2011. And at the time, the CEO was under a lot of pressure.
Steve Ballmer. Yeah.
All right. If you want to name him. Okay. Steve Ballmer was the CEO. And he was under a lot of pressure from Wall Street and analysts and investors. And your neighbor would say, why would you invest in Microsoft with him running the company? And I was like, you know what? Go back to Warren Buffett. We were talking just about with Tony, who said, you never know, CEOs come and go. And I figured, my common sense, I think it was a common sense investment. My common sense told me this is a great company. Yeah, people are not going to, PC is dead. But I also knew that they were getting involved in other things such as the cloud. And, they were just a quality company that maybe needed new leadership or whatever it was. And that turned out to be true. But I wasn't predicting that, but I expected something would happen. And at $25 a share and all the valuation metrics at the time, to me, it was a no-brainer. And if I had the moment back, I would have bought thousands of shares. And right now I'd be having this podcast from an island in the South Pacific with you guys.
But so back then, when you did your calculations, you ran your process of it, you determined that it was undervalued.
Yes, I did.
Interesting.
At $25 a share around the time, I think adjusted it might be more like $22 a share after dividends and splits, but I'm not even sure they split. But I determined my valuation metrics said it was undervalued by the market. And the reason why is because the CEO and the PC is dead. And my bet, I hate to use the word bet with investing, but I had to say to myself, I know the CEO is going to change. And I don't think Bill Gates is going to let the company go anywhere but up. That was my thought.
Funnily enough, David and Cam, when I was living in Toronto in 2013, Microsoft came up on my screens as well. And I didn't do any investing in North America when I was living there. I stayed investing in Australia. But when people would ask me what I would recommend, I would say Microsoft.
Wow.
And it's done well since then too. But I had the same response as you did, David. What? Microsoft? Forget about it. It's dead. But
has Berkshire ever added Microsoft to its portfolio?
Ooh, I don't think so. It's certainly its biggest holding now is Apple, but I don't think it's added Microsoft. Yeah. Which is, I wonder if they were stopped from doing that because of Bill Gates being on the board. I don't know.
Yeah, they're like good friends. Maybe that could be a caveat for not owning it.
Yeah. I wanted to, if I could, David, just read out. I've been plugging your book in our club newsletter for the last month or so, taking just quotes from it that I enjoyed. I thought I'd just read a couple of these out for our audience mostly, but maybe you can provide some commentary on them after I read them out. This first one's about people who try and play the trends. You wrote, from purely an investment standpoint, there are just a few market timers in each event who got in with a lucky twist of fate or the rare intuitive sense of market conditions, profited and got out. Those are the ones who dominate the financial news feeds and sponsored content, giving a false appearance of the bullishness or bearishness in the market fad among the masses of well-intentioned investors. The sobering truth reminds us the money-making headliners represent a tiny percentage of the active participants. Too many players in the fad lose money and, echoing the typical casino gambler, share only the rare winning bets. Just another reminder that market fads make money for a lucky few at the zero-sum expense of the silent investor majority that loses out from the desperate hope to make a lifetime of capital gains in a single market cycle. The list of household names who made fortunes beating the market by owning investments with utility over extended periods is lengthy. Yet, I am unable to name a celebrity investor off the top of my head who adds wealth year in and out on fast money market timing fads. Price is what you pay, value is what you get. So talking a bit about survivor bias there, I think, which we mentioned from time to time on our show.
Well, I think that, that quote, and I appreciate you reading, Karen, was really based on my observations. Some people do have the intuitive sense. I've witnessed a few people, I'm not going to name them, I wouldn't name them in the book either, that just seem to have an intuitive sense to time the market, but they're such a small minority of the population. And that is good for them. But the negative of it is, it's the old forget we used to say the 20-80 rule, now it's the 2 and 98 rule. So you have 2% that have this, that are wired DNA wise to do this. And the other 90% say, wow, I could do that too. And the truth is, no, you can't. And they try it and they fail. And unfortunately, as long as those people exist, the 2%, we'll call them, they're going to get people's attention. Yeah. Because fast money is palatable for a lot of people. And, I have to say this, Cameron, as far as the full disclosure, I saw that Get Rich Slow for the first time yesterday. Get Rich Slowly, your podcast Get Rich Slowly first time yesterday. I had when I named the chapter, the first line is informed investor. An informed investor has a far greater chance of getting rich slow than getting rich fast, but getting rich slowly is better than not at all. I had a little back and forth with my editor. So you guys will scroll my editor on this one. She says it's not slow, it's slowly. It's get rich slowly. And my answer here is, well, I understand that grammatically, but we don't say get rich fastly. Right? We say get rich slow. So yeah. I compromise whether we have slow in the title as slowly in the line. So I just had to throw that in there.
Well, I was listening to.
Sorry, Cam. Good point you make though, David, about those 2% who are hardwired to ride the trends. The other thing which I think is lost in that kind of analogy too is that those 2% tend to be 100% focused on the market all the time. They're networking their butts off. They're in the middle of things. They're probably living and working on Wall Street or something similar. They're not like you and I who are sitting at home and we have lives outside of that, and investing is just to facilitate those lives. It's very hard to go from 0 to that to 100 with that and be a 2%er without devoting your whole life to it too.
Absolutely.
Yeah.
100%.
And I appreciated that I think it was in the last pages of your book, you remind everyone that health and happiness are the most important things, not money, and to put your health and happiness first.
Yes,
which I think
absolutely. My beautiful wife of 29 years now is a type 1 diabetic with end-stage kidney disease on home dialysis. I'm her caregiver. So I'm very in tune with health being much more important than money. All the money in the world, can't get you a kidney unless you get a kidney.
I'm sorry to hear that. So I wish her well.
Yeah.
Oh yeah, she's doing great. She's in the medical books as one of the best patients ever in the history of kidney disease. She went 30 years after when she first got diagnosed. They gave her 5 to 8 years for dialysis. She went almost, 8, and she went almost 30 years before she had to do dialysis.
Wow.
She's a great patient and a great person. So but I appreciate that.
Yeah, well, in terms of similar titles to things, we had an episode come out a while back called Deworsification, which I thought Tony had made up. And then I was watching Charlie Munger's speech last week, and he said he calls it deworsification. I was like, There you go. Munger's stealing Tony's stuff again. It's scandalous at his age, 97. He's still stealing Tony's stuff and not giving attribution. Let me read another quote here, part of your investing wisdom. Despite the inevitable volatility, I have no idea and forever dismiss expert predictions on market trends, stock prices, and interest rate movements as no more dependable than the entertaining Ouija board. Remain steadfast in buying and holding the stocks of quality companies to outperform the roller coaster movements of the market over time. On the contrary, trading stocks and currencies on speculation in the quest for fast money is fleeting, and the house wins most of those wagers anyhow. I just thought that was nicely put.
Thank you.
Let's talk about Bitcoin before we wrap up. Tony sent me an email today saying we had to get someone on to talk about Bitcoin, and I wasn't sure if he was pulling my leg or not. He said, "No, I'm serious. We should probably do it." Do you have any thoughts on investing in Bitcoin, David? Because I have a lot of friends who are telling me, get in on Bitcoin. It's going to be worth $500,000 a coin.
Well, Cameron, I received an email yesterday saying that I've been granted 1.9378754 Bitcoins. I guess if you round it up, that's 2 Bitcoins, $100,000.
You just have to send your credit card details to somebody in Kenya?
Oh, yeah, very professional looking email. All I had to do is hit the little square box in order to claim my free 1.93753 Bitcoins. And to me,
specific number.
Yeah, to me, that was how I feel about Bitcoins. I deleted the email immediately.
What was Warren's quote we used recently? Rat poison squared. I think he called Bitcoin.
Yeah.
Again, that goes some of the 2%ers are making a killing on Bitcoin, but we'll see how long that lasts.
Yeah. Feels like a trend.
And what about the GME story from your country in the last few weeks? Have you been paying much attention to that?
I've read about it, of course, like everybody else. I find it fascinating that I'm a fan of and a proponent of retail investing. So, on one hand, it was great to see retail investors, kicking the professional investors' butt for a change. But the way it was handled by Robinhood, of course, that's controversial. And then, you look at Robinhood, supposed to be the, Robinhood markets in America. I don't know if they're familiar with it in Australia. I guess from the story maybe you are. But they, they're supposedly the favorite of millennials and the best, or the favorite stockbroker for the young crowd today. And maybe they just reminded us that they're also controlled by the professionals. Whether willing or not, they might not have a choice. I'm not knocking Robinhood. I'm just saying it kind of exposed what goes on behind the scenes. And Tony, you probably have a better idea what goes behind the scenes than I do as far as these how stocks are traded on the back end. But it's crazy. It's crazy.
Do you think the retailers really kicked Wall Street with that one?
The retail investors?
Yeah.
Well, maybe on the front page of the news they did. I think a lot of them were probably made aware of it and got out in time or whatever.
Hope so.
But it made for a good news story, I guess. Good headline.
Yeah, the only headline I've read of someone who made millions out of the GME saga was a person who's now facing charges for pumping and dumping it. So, yeah.
Yeah, pumping and dumping is not good. So, yeah, we don't want to be promoting that.
Yeah.
All right. Well, maybe we'll just I'll wrap up with your definition of value investing from the book, which I thought was nicely put. Buy and hold the common shares of US exchange traded, dividend paying, well-managed, financially sound businesses that produce easy to understand products or services, have enduring competitive advantages from wide economic moats, enjoy steady free cash flow, and are trading at a discount to the investor's perceived intrinsic value at the time of purchase. Next, of utmost importance, and perhaps the biggest challenge, practice patience in waiting for the investment thesis to play out as projected over a long-term horizon. Nicely put, sir.
Thank you. Yeah, I believe patience is the scarcest commodity in investing. And so whenever you own the scarcest commodity, you're probably gonna do well with it. So patience works.
That's always the thing Warren Buffett says, doesn't he?
Yes.
You don't need a high IQ, you need patience to be an investor.
And speaking of,
I'm sorry, go ahead.
No, after you.
No, speaking of Warren Buffett, I've quoted him 6 times in the book, and I hope he doesn't mind me saying this, but when you write a book, of course, as Cameron, as you know, you have to send out, permission requests to use any quotes if you're using them in your book. And I sent the 6 quotes to Warren Buffett's assistant in Omaha, Nebraska, not knowing what was going to happen, thinking he's going to come back and say, thanks for trying, but no, thank you, or whatever. And the next day, within 24 hours, now the publishing companies, the big publishing companies, have been waiting weeks for their responses. 24 hours later, Warren Buffett's assistant sends me an email explaining to me that she printed out all 6 quotes I have in the book, in the manuscript at the time. As we famously know, Warren doesn't use email, he doesn't use computers. She presented him the printed emails. He read each one of them, signed off on each one of them, gave them to her, said, wish Mr. Waldron the best on his book.
Wow.
24 hours. 24 hours later.
Did you frame that?
24 weeks later, I got some of the major publishers' permissions, or not.
Ken, we need to write a book and put 100 Buffett quotes in it.
Yeah. So I had to share that story because it was a wonderful experience, because his reputation doesn't precede him. His reputation is who he is.
Yeah,
well,
absolutely.
The story I've told too many times, David, is about, I don't know, 16 years ago, in the early days of podcasting, Steve Jobs got up on stage at Macworld and said that they were going to put a podcast directory into the next version of iTunes. And I did a blog post that day saying, well, that's nice, Steve, but how the hell do we get our podcasts into it? You didn't tell us that. And I woke up the next morning with an email from Steve Jobs saying, wow, Cameron talked to Eddie Q. And I sent Eddie Q an email. He's now senior vice president at Apple. I sent him an email saying, I'm not sure if this is real or not. And he replied right back saying, oh, no, that's real. And here's what you need to do. So, yeah, guys like Steve Jobs and Warren Buffett, impressive, their attention to that kind of thing.
Well, Cameron, I wonder if you might have spurred Steve Jobs to realize that podcasting was one of Apple's best kept secrets. Right, the podcast was invented by Apple, and they never really promoted it until recently. They kind of hid it behind the scenes. Yeah, so maybe you got his attention on that one. He said, "What are we doing with this podcast? And let's get it out there."
Yeah, and I've been waiting for them to figure out a way to help us monetize it ever since, and they're not interested.
Yeah, I guess it's still there, hiding it in the background.
Anyway, David, we should let you go. Thank you so much for taking time to come out and chat with us today. And congratulations on the book again for the listeners. It's Build Wealth with Common Stocks. You can get it on Amazon and every other online bookstore, I guess. I'm not sure if it's in bookstores in Australia, but we can order it online here. Great book. I thoroughly enjoyed it. And congratulations on your success as well.
Thank you very much, Cameron and Tony. I appreciate it. And thank you both for being a new source of value investing wisdom for me. Much appreciated.
Thanks, David. Really enjoyed the book, and good luck, mate.
Thank you very much.
Okay.
Thank you, mates.